Today we are going to talk about Economics Class 12 and Class 11 Chapter National Income and Related Aggregates prepared and presented by Prama Maity. So what do you mean by macroeconomics? Macroeconomics is the study of the aggregate economic variables of an economy. We can see that a picture is given in the right hand side of the PPT. Now let's talk about some important concepts. What are goods? In economics, goods are the materials that could command a price in the market and that satisfy human wants and provide utility. Now what are consumption goods? Consumption goods are those goods which are brought by the consumers as final or ultimate goods to satisfy their wants directly. Consumption goods are of two types. It is shown in the picture. Now what is a service? Services are any action taken by one person or the group for the another in exchange for the payment. For example, medical checkup, teaching, etc. Now what are capital goods? Capital goods are those final goods which are used and helped in the process of production of other goods and services. For example, machinery, building, etc. What are final goods? Final goods are those goods which are used either for final consumption or for the investment. They are not meant for resale. For example, fruits purchased by the households for own consumption, TV set purchased by a household for his own entertainment, etc. Now what is intermediate goods? Intermediate goods are those goods which are used either for resale or for further production. Example, fruits purchased by the juice shop owner to prepare the juice and to sell it. The TV set purchased by a dealer for reselling it. You need to note that whether a good is an intermediate good or a final good, it depends on the final use of the good. Suppose a household purchased milk for the consumption, then it is the final good. But if a person purchased the milk for his tea shop, then it is the intermediate good, as here milk will be used further for making tea. Now here you can see that a circular flow of income is given. It says that it refers to a cycle of generation of income and its distribution among the factors of production, which are land, labor, capital, entrepreneurship, and finally its circulation from household to firms in the form of expenditure, which means that first the production phase, then the income phase, and then the expenditure phase. A chart is also given in the right hand side for a detailed information. Now what are the types of circulation flow? First comes the real circular flows, which means that it shows the flow of goods and services from one sector to the another. And the another is the monetary circular flows, which means that it shows the flow of money and income from one sector to the another. As shown from the diagrams, you can understand it in a far better way. Now let's quickly talk about the stock and the flow. Stocks are mainly the variables whose magnitude is measured at a particular point of time and are called stock variables. For example, national wealth, inventory, etc. And what are flows? The variables whose magnitude is measured over a period of time are called the flow variable. For example, the national income, change in stock, etc. Now for your benefit, there is a chart given here which says the difference between the stock and the flow. In stock, unsold goods at a point of time, and in flow, there is a dynamic study of stock over a period of time. In stock, measured at a particular point of time, but for the flow, it is measured over a period of time. The static concept of stock, and that is the dynamic concept for the flow. It is a not time dimensional for the stock and it is a time dimensional for the flow. For example, the stock of goods on 31st January falls under stock. For example, the study of stock over the complete years falls under flow. Let's talk about the leakage and injection. What is a leakage? It is the amount of money which is withdrawn from the circular flow of income. For example, taxes, savings, and import. It reduces the aggregate demand and the level of income. Now what is injection? It is the amount of money which is added to the circular flow of income. For example, government expenditure, investment, and exports. It increases the aggregate demand and the level of income. Note that when the economy is in equilibrium, then the leakage of the money equals to the injection of the money. Now let's quickly write down the differences between leakage and injection. In leakage, the withdrawal of money from the circular flow, and in injection, it is the introduction of money in a circular flow. In leakage, it implies the decrease in level of income. In injection, it means the increase in level of income. For the leakage, it reduces the aggregate demand, but for injection, it increases the aggregate demand. In leakage, it reduces the flow, but for the injection, it increases the flow. I hope this much is clear to you all. Thank you.